Have you noticed something kind of strange? Every time the stock market drops, the president looks more nervous than traders. And at the same time, the headlines suddenly get intense. Markets tumble on fears of slowdown. Wall Street rattled. Confidence shaken. It makes you wonder, is the U.S. stock market actually allowed to go down anymore? Because for the last 15 years, it kind of feels like everyone in power, government, central banks, even the media, really wants it to keep going up.
Think about how we're all conditioned now. 5% drop, buy the dip. 10%, people start saying the Fed will respond. Something breaks, liquidity shows up. QE, emergency facilities, stimulus. Since 2008, we've learned one lesson really well. If markets fall too much, someone will step in. And to be fair, that belief hasn't been wrong very often, which is exactly why it feels so stable and also why it might be fragile.
Here's the thing. GDP is quarterly. Jobs numbers are monthly. Inflation lags reality. But the stock market updates every second. It's the fastest confidence indicator in the country. So when stocks fall, it's not just Wall Street losing money. It's retirement accounts, consumer confidence, hiring plans, and yes, re-election odds. That's why modern governments aren't neutral observers anymore. A sustained market drawdown isn't just an economic problem, it's a political problem.
Now, here's the part people don't like to talk about. The media isn't just reporting on markets. It's part of the feedback loop. Think about it. Markets go up. Headlines talk about resilience, strong fundamentals. Markets wobble. Suddenly it's panic, uncertainty. What went wrong? Markets recover. Confidence restored. Investors rewarded for patience. The system works. That framing matters. The media doesn't just inform sentiment, it amplifies it. And it's not conspiracy, it's incentives. Rising markets equal good for advertisers. Bull markets equal easy to explain. Optimism equals clicks without panic. A calm, upward market makes institutions look competent. So the drum keeps beating.
Now let's talk valuation, because this is where the loop closes on itself. QE pushes rates down. Lower rates justify higher PE ratios. Higher PE ratios become the new normal. Then investors look around and say, well, this must be reasonable because policy allows it. Media reinforces the story. Valuations reflect growth. Markets are forward-looking. This time is different. And suddenly, high prices justify themselves. Policy supports valuations. Valuations justify policy. Media smooths the narrative. Nobody feels irresponsible because everyone's aligned.
Here's the part that really inflates markets. Investors start believing something almost magical. The upside of investing in U.S. stocks is unlimited, but the downside is protected. Think of it like this. Even if things go south, the government might step in. Bailouts, stimulus, nudging foreign investors, whatever it takes to keep markets afloat. When that happens, the classic balance of risk and reward disappears. Normally, investing is a gamble. You could win, you could lose. But now, with the downside buffered, investors feel almost nothing can stop the market from climbing. And guess what that does? It pushes stock prices higher than they really should go. It's like playing poker where someone promises to cover your losses if you get a bad hand. You'd play way more aggressively, right? Same thing happens with stocks. The more people believe the downside is protected, the more they bid prices up, creating a self-reinforcing bubble, until reality eventually catches up.
High valuations need oxygen, and that oxygen is stories. Internet, sharing economy, crypto, AI compute, AI memory, AI power, AI everything. Some of these stories change the world. Some are just financial sugar highs. Markets aren't pricing certainty, they're pricing option value, and the media helps extend the lifespan of those stories. As long as the story survives, the multiple survives.
This is where trust starts to crack. In 2021, CPI peaked around 9 or 10%, but for a lot of people, that felt laughable. Rent, food, insurance, childcare. For many households, it felt like 20 or even 30%. So people asked the obvious question, how is inflation even being measured?
CPI isn't fake, but it's not personal. It's a statistical average. It uses substitutions, quality adjustments, and housing measures that lag reality. If steak gets expensive and people buy chicken instead, CPI says inflation slowed. Your wallet says you just downgraded your lifestyle. Housing, the biggest expense, is measured using owner's equivalent rent, which lags by more than a year. By the time inflation is official, people are already exhausted. When CPI finally cools, media says inflation is falling. People say, my bills are still insane. Both are true, and that gap destroys trust.
Here's the key point. Markets don't crash because politicians or media decide they should. They crash when constraints take control away. Inflation, currency credibility, leverage, market plumbing. In 2022, everyone wanted markets higher, but inflation said no. That's the difference between influence and control.
Big crashes don't start with fear. They start with confidence. Confidence that dips are always bought. Confidence that liquidity is infinite. Confidence that media will calm everyone down. Confidence that policy will step in. That confidence builds leverage quietly. Then something small breaks, and the unwind is violent. Not because people were reckless, but because everyone believed the same story.
So yes, the stock market today is heavily managed by policy, by incentives, by narratives. But management doesn't eliminate risk, it compresses it. You get fewer small corrections and rarer larger pullbacks. Not because the system failed, but because reality eventually overruled the story.
So here's my question. Do you think the bull market is organic or partially orchestrated? And if it is orchestrated, what happens when the drum beating stops? Let me know in the comments. And if this video made you slightly uncomfortable, that's probably the point.